Hi everyone, welcome to this webinar. Hello Adinda and Matias or Ani. I don't know who's going to be our moderator today since they're both in the room. Ani, hello. As usual, my pleasure to be here with you again. And before starting, I want to apologize with you all guys. I have not been able to be here past week. And honestly, I'm still with a terrible flu. I can't get better. I don't know why, so my apologies if I interrupt a bit the webinar, okay? But, well, let's try to enjoy a bit of what the technical analysis, if it's possible, today, talking a bit about stochastic oscillators. The fact is that the idea of the beginner's corner is to help us all to improve our trading strategies, not only just beginners, but I would love to share some extra tips and tricks that we don't see in books or we don't find in books when finding indicators. Okay, so let's start with this stochastic oscillator. As you know, this indicator was introduced by George Lane, okay, and it's based on the idea that when a pair or an asset is in the bullish trend, right, price usually tends to close in session maximums, right? It's pretty simple concept. And when the trend is bearish, or the dominant trend is bearish, the price of a currency pair will usually tend to close near the session lows, right? With this concept in mind, Lane tried to find a mathematical relationship between the close price and those maximums and minimums from each session. The fact is that regardless what we saw when we plot a technical indicator in our charts, they are all based in mathematical relationships in between price and time, which are the main factors that dominate the forex market, right? And despite we are seeing different color lines plotted on places in different zones of our charts, either below or in the middle of our charts, the fact is that all those mathematical studies or those mathematical relationships are just giving us the information of what happened in the past, right? Keep that always in mind. They are telling us what happened in the past, and in a way, they will help us to forecast what's going on, what could happen in the future, okay? And we could make statistics of how this behavior of a certain currency pair repeats over the time, and then base our trading strategies in those. But always remember, there's not indicators. Indicators are just tools. That's not the tool, it's how we use it and when, okay? Anyway, this stochastic oscillator, as you may see, is plotted in a chart below our main chart, and it's formed by two lines named %K and %D, right? The green line, the key line, okay, tries to find a relationship between the maximums and minimums of and closing prices, right? Of course, in this particular case, of 14 periods as it's set by default to 14, okay? So that key line is trying to tell us the relationship we can see in between the highs or the lows of the sessions in regard of the close of those periods, okay? On the contrary, on the other hand, we have that red dotted line, right? That is the %D, right? And the fact is that it's just a simple moving average, right? It's like an average of the previous 14 periods of the key line, right? But it's usually of a lower time frame. It's got by default 7. We are going to see different ways to plot these indicators, right? The different numbers and how to set them, right? And the idea is that this simple moving average, right, will smooth a bit the reaction of the key one. As you may know, this indicator, the stochastic oscillator, as relative strength index and another one, show us when the currency pair is in oversold on overbought territory. The fact is that it usually comes in between 30, 25, 70, 75. I tend to plot my oversold over both limits in 20 and 18, never below. I believe that it's better to miss a trade and lose a trade, right? So to determine it oversold or both readings, it's better to do it as wide as possible. So let's work with 20 and 80 and not 30 and 70, right? So that's the first thing, okay? So we know that these two lines, right, move in between a range marked between 0 and 100, right? So that makes of the stochastic oscillator a closed one, a closed indicator. And so when the market is in the final trend, usually, right, tends to saturate at extremes because it's capped by the 100 limit, right? So that's why I always suggest to use stochastic oscillators when we are in sideways moments in the market, in consolidated stages, and not when we have a clear defined trend. Maybe you don't know, but if we move to smaller time frames, you will notice that most of the time, right, the market is involved in this kind of sideways movements. More lately in this time of the year, right, we are in summer vacations in the North Hemisphere. We have no much of a trend definition. So that's why I do prefer to trade with these indicators when we are in sideways markets, right? Anyway, we can say that a pair is overbought, as I would say, when above 80, right, and oversold when below 20, right? The fact of being overbought or oversold does not mean we are going to see a reversal. As I would say, we can see the price continue rising, indicators saturating, okay, at the top when we have a defined trade. This is one of the most clear examples we can see the indicator turns flat, right? It's unable to continue rising above 100 because it can't, okay? But the price keeps rising. We have a clear trend. That's why I usually recommend that if you want to attempt to trade with any kind of stochastic oscillator, you need a MACD or a momentum to filter either if the market is in trend or not, right? If we are in the middle of a very trendy market, like in this particular case, most likely is that you're going to get fake selling signals when we see some limited corrective movements in the price action while the trend continues developing in its ongoing trend, right? So really beware of that, and beware that the stochastic oscillators are better used when filtered with a trend indicator. You can also use the moving average, right? Something that is telling you if the market is flat or not. Anyway, this indicator, okay, tends to give us, I choose this movement in the market when we have clear buying and selling signals when price is moving sideways. So we are going to see the different kind of buying or selling signals we have in the indicator, right? We usually said that we have buying signals when any of both lines, right, any of both lines regain the 20 level downside up, right? Like in this particular case, we have the key line, crossing in the first place, right, the 20 level downside up, is giving us a sort of buying signal, right? And on the contrary, we are going to see a selling sign when the same line, the key one, the green line, crosses upside down, right, the 80 level, like in this particular spot, okay? I'm going to talk a bit more, and then we are going to make a small interruption to see if you have questions, okay? Anyway, remember to add that trend indicator to filter this, okay? Maybe that trend indicator will tell you that the dominant trend is exhausted or this is about to reverse, so that will help us to figure out if that signal you are seeing in the indicator is valid or not. Anyway, there's another way to read the signal a bit before the movement, the corrective movement or the trend change already started, and that's it when the key line, the green one, crosses the red one, okay? This is the first sign, upside down in this particular case from selling, or downside up for buying, right? Either, of course, and it has to happen outside the 80-20 zone, right? So, despite this is telling us in the first place or a bit earlier when to sell, like in this case, or in a year, right? That is pretty much above the price we have when we get this signal, right? And the fact is that sometimes when the dominant trend or the indicator starts saturating, you will get a lot of fake signals. So if you are going to attempt to take a trade just because the key line crosses the big one or the green line crosses the red one, you are risking more. Your risk reward ratio is higher. Okay, despite you may see it before we have a more conservative or more clear signal, that is the first one when both lines crosses the level, right? You have an advance. At least if not trading the fact that the green line crosses the red one in the market direction and the right direction, at least giving us a warning whether the indicator is about to trigger a signal or not. I really don't recommend this kind of crosses to be taken as go-up signals, right? Unless we have some sort of golden cross, right? Remember, the golden cross are the ones that we see more vertical, like in this particular case, right? This is a more golden one, right? While this is just flat, right? We have no verticality in the green line. In fact, it's flat, right? When we cross the red one, right? In this case, it's not. Or in this case, it's not flat. It has a nice curve. In this one, it's also not flat, okay? It's also an interesting one, right? So beware of the kind of catch you see in between these two lines before taking the signal, okay? If it's a golden one, well, you may try to attempt a trade. Of course, remember to place your stop loss, I would say above recent highs, okay? Because we are assuming that the market will continue moving sideways and we have reached the top, right? In this particular case that we are talking of a selling signal, or we have reached a bottom when we talk about buying one. So watch for recent lows and place your stop a bit below, I would say 5-10 pips plus spread away from that previous high or low, okay? Anyway, when the green line crosses the red one in or sold over both territories, despite being effective only when golden, right, are at least advancing us that the trend in the right direction may continue, okay? Another interesting way to confirm that is wait for the green line after we get into the trade. If the green line crosses the 80 line in this selling particular case, right, you will notice that the next line takes a couple of candles later to do so, right? That is a technical confirmation that we are in the good side of the market, okay? That's the technical confirmation that we are okay and that the price will probably continue going lower. Where do I leave my trade? As soon as the indicators reach the red one, reaches the opposite side, okay? It reaches the opposite stream. We are assuming that the market is moving sideways, so we have reached the bottom, and when the red line approaches to the contrarian level 20 or 80, right, we understand that we are reaching or approaching about the bottom of the top and that the price action will start reversing, okay? The other way to take a look at the signal in this particular indicator, okay, is to try to detect divergences between the D line and the price chart, meaning divergences in between the red line, right, and the price behavior. Why the red line? Because it's faster, okay? So if I see, like in this particular case, price heading lower and lower and lower, and the red line going higher and higher and higher, right? That kind of a divergences with price heading lower is telling me that at a certain point we are going to find a bottom and we'll probably reverse them. However, when trading in smaller time frames, like 1 hour or smaller, the fact is that you will need another filter or another technical indicator to determine whether the reversal is going to take place or not. I usually add again a trend indicator, right, like a momentum indicator or MACD, right, to see if that other indicator is also showing signs of exhaustion. Anyway, in this particular case, right, having that divergence, the fact is that we were going to get a buying signal when both indicators line crosses the trend line, that broke the trend line in the in the inverse direction, right? So we are catching the sign too late. Honestly, divergences are not my best friend ever, right? Anyway, one of the things I would like to add before making a small pause and letting you ask questions if you have so, is that as you can see, the cross has several crosses, the indicator, has several crosses up and down across the day, right? And maybe sometimes you will consider this to be rather violent. And that's why you can modify this kind of setting, right? And made it a bit slower, okay? There are several ways to make it slower, changing the number of periods involved in the indicator. I have already a slow one, okay, and have changed it to 853, right? That will tend to slow a bit the curves in the indicator, okay? Slow a bit. The fact is that the one I rather preferred, and I always preferred, despite being quite short time frames, is the 533. I believe that kind of stochastic signals are a bit more interesting to follow. We have a faster in stochastic in this particular case, right? We have found bottoms and tops pretty fast, as you may see in this example. But trading with this kind of 533 requires a lot of self-experience, practice, and speed when taking trading decisions, okay? You could not hesitate over taking out not the trade because it may be too late. So I would say that if you are not too much experienced, start with the 1473, then change to the 533, okay? In the case of pound dollar, right? If you take, I have been taking a look at the early chart for the last couple of months, a bit more honestly. And first is that using the 533 indicator in the early chart has been 79.6% reliable, meaning 79.6% of the trade had been positive. The stop loss is around 25-30 pips plus spread, not that much more. Okay, average and say, okay? And the profit tends to be a bit more than 50. So the risk reward ratio has been pretty interesting over the past month for this particular cross with this particular set, okay? As last word, and I know it's repetitive, remember this oscillator works better in cyclical sideways markets, right? Where market is in a well-defined trend, signals are usually fake, and the oscillators tend to get exhausted in the trade, saturate, as I told you, and not giving us too much of a trustful trade. So in those particular cases, when you see the indicator turning flat, right at the bottom or at the top, without golden crosses, right, then ignore the signal. It's better to miss a trade and lose one. Okay? You just need to sit in front of the computer and understand how the indicator works. We will go to a short-term trading strategy with the stochastic oscillators, okay? As you may see, I'm having here a 15-minute chart for the euro dollar, okay? It's a trading strategy that in fact has been developed for even smaller time frames. But honestly, I don't like it that much in smaller time frames. I believe that the risk-reward ratio and the number of pips you can get from a 5-minute chart or even a 1-minute chart, that's not worth the effort. Okay, that's not worth the effort of trading, right? Anyway, I will enlarge a bit the stochastics. Okay, as you may see, I have a very, very fast one and a very, very slow one. We are going to take a look at the settings, okay? The slower one, as you may see, is a one of 120 periods, right? B3. And the other one, fast one, okay, is a 15 period 133. 3. Okay, so I will close this, and as you may see, we have a very slow stochastic oscillator and a very fast one in comparison. Okay, so how do we work with these two stochastic oscillators? The fact is that sorry, we need to a bit of a practice on watching the market before starting to trading with this, but it tends to be quite interesting and reliable. Okay, also let's find a starting point. Sorry, I will change the color. Sorry, black, red. Okay, there we are. Sorry. Okay, there we are. You need to find a starting point, meaning buying or selling signal somewhere. Okay, that's the first thing we need to take a look at. I need to find a signal. Okay, because the one of the conditions to get into the market, right, is to have before, okay, a signal of a trade in the opposite direction of the one we are taking. Okay, so if in this particular case, as an example, okay, we are going to have buying signal, right? Previous one should have been a selling one. I cannot trade if I have two buying signals in a row or two selling signals in a row, right? Previous one has to be a contrarian one. Okay? So you have to spend some time looking for that before starting. But anyway, we have a buying signal when previous signal has been a selling one. Okay? Previous signal has been a selling one, right? And the slow stochastic, right, should have been shortly ago, right, in the opposite side of the range. Meaning, if I'm going to buy, I will have to have the stochastic, slow stochastic, near 80 in a short time period before getting into my signals. Okay, the fast one, okay, should be less, okay, or equal to 40, right? In this particular case, it should be below 40, right? After being in the opposite extreme, should be equal or less than 40, sorry. Okay, while this fast one, right, the green line should be above the red one, the one that gives us the signal, the green one, right? And of course, the same should repeat in this particular one when the green line is above the red one. Let's see if we can find a clear example or more clear one, okay, to see if you understand what I mean. I know it's a bit complicated, right? It may sound a bit complicated, but once you use your view to this kind of signals, they're pretty interesting, okay, and pretty good to take. We are going to market cap, okay? Okay, in here. Right? In this particular case, right, I have a buying signal coming from the fastest one, right, as the green line, and the red one are crossing both the 20 level, right, the contrarian side, right, upside down, and the green line is barely above the red one as usual, right? The slow one, right, is near 80, more near 80 than 20, right? And it has been there shortly ago, right? So that's supporting my signal of buying the cross at that particular moment, okay? The past one already overcomes 40, so more signal in my favor, right? And of course, the green one should be above the red one when I get the signal. In this particular case, as you may see, this is a great signal, right? A great buying signal that, if I took it, has given me over 130 pips with almost no drawdown. On the contrary, see what happens in this particular selling signal. I have a selling signal in here with 80, but my slow stochastic has never been close to 20, okay, to the opposite side. See, it has remained near the 80 area. So this is not a good signal. This is a bad one because despite the fast one, it's giving me or telling me to sell, right? The line or the stochastic in the slow one is not in the opposite side of the market. It's not near 20. Okay? And see what happens. Spike price has fallen a bit. It's no way giving me 100 pips. And of course the price continues to the upside lately on, making that a very bad trade. Okay? So that condition of the stochastic, the slow stochastic, being on the contrarian side of the of the market, right, is key to get a positive trading signal. Okay, in this particular case, again, I have a buying signal. Sorry, not here. Here. Okay, I have a buying signal from the fast one, right? While the slow one has been, okay, or it is above 80. So once this one moves above 40, I'm getting a buying signal. Despite it takes some time because probably it's in the middle of the Asian session. Fact is that I have been 120 pips up, right? And never had a strong drawdown in this particular example. Okay? So the condition to take trade with this is that's why I'm getting a certain buying or selling signal from from the fast one, right? The slow one should be in the opposite side of the stochastic limit. Weird, right? Pretty weird, but honestly, it works pretty much. Consider to use a take profit in between 50 and 70 pips, not 120 or 130 like we've seen in these examples. I would say that in between 50 and 70 is pretty much logical, while the stop loss should not be much more than 30, 35 pips plus spread, okay? One more thing that you may consider interesting is that you may want to leave your trade, okay, if you're in the middle of a buying trade, right, the fast stochastics, right, overcomes 80 and reaches the 90 area or 95 level. Yet on contrary, if you are in a selling trade, right, the fast stochastics reaches levels below 20, like 15 or 10 or even lower, right? That's showing us that no matter how much positive you are in the market, maybe 5, maybe 10, maybe 100 pips, don't care, right? Or maybe just one down. Fact is that the price has probably reached the next extreme, a bottom or a top, right? And there are chances that it will probably reverse and move against your trade. So you would rather leave your trade in the conditions it's right now, that rather than wait and lose till you stop loss. Okay? Keep that in mind when trading. Okay then. I will leave you for today. Hopefully we will be back again on Sunday with the market opening. And I will try to prepare something a bit more interesting from next Friday, okay? So we can go deeper into the trading strategies that may work or may not with certain currency pairs. Okay? Thanks all for being here and hope you had a great weekend, okay? Enjoy it. See you.